warmly to my lecture on triangular arbitrage. In this lecture, we would have few words, few concepts, but each one of them are precisely defined. So we are going to focus on every word. First is word triangular. You are familiar with a triangle. A triangle has three different corners. This triangular arbitrage also involves three different trades in foreign currency. The word arbitrage needs a precise definition, which I will do later in these lectures. Next, I would like to talk about dollar-based spot market quotations or quotes in London. Dollar-based. The word dollar-based means that this particular market for foreign currency in London trades each currency against dollar. So in that market, you can trade British pound against dollar, you can trade euro against dollar, you can trade yen against dollar, but you're not allowed to trade directly euro against yen. So only trades involving dollar are taking place in that market. London is the largest foreign currency market because over several centuries it had had that money center position, and even with euro exit, it has not lost that position. And these dollar-based markets um, are a relic of a time after Second World War where most of the currencies of the world was tied to dollar, and dollar had a central position in terms of currency value. That central position is still maintained to this day, and euro has not replaced dollar as main trade currency of the world. Next, let's focus on the word spot market. The word spot market um, is in uh, is used for a market that trades on the spot. Imagine that you pay me 200 euros on the spot cash and you purchase my laptop. That's a trade in the spot market. This is as opposed to trading in futures or forward markets. Notice that we have two different names for those markets. The difference between these two different names is technical, and later on in these lectures we get to this difference. But right now we treat them together, futures or forward markets. In that market, we would trade in the future. We make a contract today. You and I sign on a piece of paper, and you promise to pay me some money, and I promise to sell you my laptop, and you put a date on it. Maybe when these courses are over with and I don't need my laptop. Say June 1st. And our price does not have to be the same price as the spot market. Not 200 euros, but say we agree on 150 euros if you buy it June 1st. This could be because the laptop gets older by June 1st, or it could be that the demand and supply conditions for trade of a particular item is different in a future date. A spot market versus forward or future markets. In fact, the first forward market that we know of um, is written as a contract on a tablet, not the electronic tablets that you and I have, and write on it, um, but a clay tablet that with a hammer and chisel one writes on it. Um, we know this because this clay tablet was found in archaeological diggings of ancient Greek times. That tablet specifies a contract where someone have walked to the olive gardens and have told the owner how much for all your olives at the harvest time. The owner had specified a future price and they have made a contract on it, and that contract is written down on that tablet. Now, this contract protects the owner because you would get a fixed price for your olives. If there is a glut of olives in the market in the future, an uncertain event that you don't know, you will not have to sell your olives very cheap. Similarly, if there is drought and olives are scarce and become very expensive, the olive oil maker who is purchasing this commodity does not have to pay a high price under those conditions because a while back the olive maker made a contract for a fixed price in the future uh, or forward market. Okay, dollar-based spot market quotes in London. I've taken these quotes from Harvard Business School lecture notes. These are not real-world quotes today. However, we can get quotations for foreign currency values from a Bloomberg terminal or from other financial data providers or Google them and see them on internet. Let's imagine that these are the quotations for trading in London. A dollar equals 111.91 yen. A dollar equals 87 cents or 0.87 euro. These are directly quoted rates. Now it's time for us to define another uh, term, and that's called implied rate. Implied rates are different from quoted rates. Let's see why we need this different term. Going back to this dollar-based market, we see that yen and euro are not traded against each other because that trade obviously would not involve a dollar. So a direct trade is not possible. But there are other well-functioning markets where yen and euro are traded against each other. For example, the market in Frankfurt or the market in Tokyo. Those markets would give us a direct price or a coded rate for yen versus euro. However, we could also exchange yen to euro in two trades in London. For example, we give our yens and receive dollars. That's one trade. And in the second trade, we hand in our dollars and receive euros. These two trades together would give us an exchange rate for yen against euro. That exchange rate is called the implied rate. To calculate the implied rate, which is something that you should learn to do, we could simply write those two equations that we had earlier on, these two simple equations here, and divide the two sides of them by each other. $1 divided by $1, the two dollar signs vanish, gives us 1. And I wrote this one on the right hand side of the equation. And then we divide the other two sides of the equations, or 111.91 yen by 0.87 euro. 111.91 yen divided by 0.87 euro equals 1. Okay, now we have an equation which we can simplify. Notice that I kept the units yen and euro. This is a good practice to have in everything that you do in this class. And this is an engineering practice, keeping the units. All right, so 111.91 divided by 0.87, using our trusty old calculator, we get 128.63, and I wrote this on the right hand side of the equation. And yen divided by euro, the units stay. Remember, we kept them for convenience, and that helps us now. The euro, which is downstairs, American way of saying the numbers are divided by euro, there is a division here, does a somersault. And you know what the somersault is, puts its hands down and goes over its head. Euro comes from down here and goes to the other side. So here it becomes 1 euro. And yen stays where it is. And of course, we did this division, 111.91 by 0.87, and got 128.63. And the yen here, it stays here. Okay, so 1 euro equals 128.63 yen. And that's if we do two trades in London, and we get this implied rate, but it's not a coded direct rate. So if you call London and you say, I want to trade euro against yen, they say, we're sorry, we don't do that trade. But you can say, I want to trade euro against dollar, and then later on, you could tell them, I want to trade my dollars against yen, and in 2 steps, you get euro converted to yen. In fact, in my exams and when we do exercises in this chapter, if you do this action in 1 step, converting euro to yen at a rate of 128.63 yen per euro, you would get the right answer, but technically you would be wrong because this cannot be done in 1 trade, and you should specify 2 different dollar-based trades, and then you would receive the full grade for that exercise, or you would be correct. However, if you like, there is a cross market. Notice this terminology. A cross market as opposed to a dollar-based market. A dollar-based market is a market that trades a foreign currency against US dollar. A cross market is a market that trades 2 foreign currencies against each other, and US dollar is not involved. As I mentioned before, this cross trades for euro and yen can take place in Frankfurt or in Tokyo, where there are 2 major markets for it, or somewhere else. Let's say we go to Tokyo market, and this would be a spot market because the rate coded is for trading right now on the spot or cash. €1 is 128.03. Now we arrive at our main idea of arbitrage. Very soon, or in the next slide, I would precisely define arbitrage. However, the basic idea is something that my old professor in University of Wisconsin had written on his office door. He said, or he had written on his office door, buy cheap, sell expensive, and you would get rich. That's the idea of arbitrage. We want to purchase something cheap and sell it expensive. But to do that, the first step is to know what is cheap, what price is expensive. And that sounds elementary, but could confuse us in an exam or in real world. So let's ask ourselves that question. In which market is euro expensive? To answer that, let me go back and backtrack. In the Tokyo spot market, euro was 128.03 yen. In the London dollar-based market, an implied rate of 128.63 yen for euro was available. And now our question is, in which market is euro expensive? Let's think about this question a minute. Okay, I believe you're ready with your answer. Euro is more expensive in London. The price is higher than Tokyo because we could simply treat the yen value as the price of euro. In London, we pay 128.63 yen to get a euro, and in Tokyo, we pay 128.03 yen to get a euro. 128.63 is greater than 128.03. You pay more yen for a euro in London than you pay for a euro in Tokyo. Okay, let's go to a clear definition of arbitrage. Perhaps you have guessed it by now. Arbitrage involves two markets. In our example, we had a market in Tokyo and a market in London. Each one of these markets has a different price, two prices. But these two prices are for one product. That product could be a physical product. For example, apples could be cheap in one market and expensive in the other one. In our case, that product was a currency. For example, euro. Euro was cheap in one market and expensive in the other market. There were two prices for it. And the product was euro, and the two markets were London and Tokyo. The other things about arbitrage that we should mention is this fact that my old professor said buy cheap and sell expensive, and that's what arbitrage jurors do, so you have an arbitrage profit. We should also mention that arbitrage has no risk. But we want to be more precise about this risk. We call it no business risk. And this idea is also tied to a short trading time. Why are these two ideas tied together? Because if you put your capital down in a very small period of time, there would be very little cost of capital or very little capital at risk. But there is a more important reason behind this short trading time. When a trader wants to do arbitrage, that trader has to compete with other traders who are doing the same thing. They're all buying it cheap, and they are all trying to sell it expensive. Well, as these orders to purchase come in the market, the price keeps going up. So if we don't do this in a hurry, notice I'm just speaking faster, trying to do it in a hurry. If we don't do this in a hurry, the prices change on us. They become more expensive. So we are trying to buy it cheap, but we end up seeing a higher price. So we want to do this fast. So arbitrageurs do all kind of tricks to be close to the market and to close the deal faster. In these times of internet, we hear about people having internet lines that are physically faster and closer to the exchange in order to do arbitrage. Old times, arbitrageurs used to have a phone line and that would call the other party, and while the market is running, this phone was always running and they were paying for the call, but this way they could immediately speak and say purchase or sell something so they can execute their trade fast. But there is a risk to arbitrage, and that's called execution risk. Execution risk has to do with executing your order and the price that you would get as your order gets executed. Well, you might say, uh, can't I specify a price and say, I want it at that price, buy it for me at that price that I see on my laptop, sell it for me for that price that you're quoting me, and that's the only price I take? Then I wouldn't have execution risk. They wouldn't give me a different price. I mean, there is something funny here. They're talking about um, coding one price and then switching the price on you. Well, it turns out that there is a trade that is called market order. In a market order, you say whatever the price is, purchase the item for me. And there is a trade that says price order. You say I'm seeing a price of 116, purchase it at that price of 116 for me. It turns out that in order to do arbitrage, let me come back after the pause. It turns out that in order to do arbitrage, a price order does not work because at the times where arbitrage is available, the market is fluctuating a lot in price, is very volatile, and therefore, if you place a price order, you are sure not to receive your order at that price because by the time even the small amount of time that it takes for your order to go to the floor and get to the traders and get actually executed and traded, the market price have changed because quite a few other arbitrageurs are getting involved in this activity. So we must do a market order in order to be able to do arbitrage. But when we do market orders, sometimes the market changes so much that something that used to be cheap becomes too expensive because too many people purchase it and run the price up, and therefore we run an execution risk. So execution risk is that you attempt to purchase something cheaply, but you end up paying much more for it, and therefore you would have a loss when you sell it. You buy it more expensive, then you can sell it later. And the reason for this is that the market changes when all the other arbitrageurs are purchasing and driving the prices up, and selling an expensive item and driving the price down, and the price might totally change against the seller. So far, we learned about arbitrage verbally. Let's go and actually do one with numbers, and learn more from doing it with numbers. We're paper trading. Since this is not real money, let's take €1,000,000, right? We don't have to pay for it. So we are going to start with €1,000,000. Of course, the arbitrageurs often work for large firms, they're often employees, and they have lines of credit, and their firm has this money lined up with the banks. So we want to sell euros that are expensive in London, something that we established in a few slides back. Euros were expensive in London and euros were cheap in Tokyo. So see, in a minute we are going to buy cheap euros in Tokyo. In fact, there are four prices here. Two of them I just talked about. Euros being expensive in London, euros being cheap in Tokyo. The other two are yen, and yen is exactly the opposite. Euros are expensive in London, therefore yen is cheap because it takes more euros. Uh, it takes more yen to purchase this expensive euros in London. And yen is expensive in Japan, where euro was cheap, because it takes less yen to purchase this cheap euros in Japan. Okay, the rate quoted for us in the dollar-based market was 87 euro cents equals a dollar. We have €1,000,000 and we want to convert it to yen, but it's a dollar-based market, so we have to first convert it into dollars. €1,000,000 divided by 0.87 euro per dollar equals to 1,149,425.29 Again, notice that I keep that engineering convention of keeping the units. The 1,000,000 is euros, and then it's divided by 0.87 euro divided by dollar, or euro per dollar rate. There is an advantage to this. Notice that euro appears in the numerator and in the denominator, upstairs and downstairs. We can cross out these two euros. All that remains is dollar, and dollar would come out. As I said before, it does a somersault. This is really 1 divided by 1 divided by 1 divided by dollar. Dollar comes out, and the answer is in dollars. This is useful if someone gets too hurried up, or in an exam is under stress and doesn't remember if they should divide or multiply by 0.87. If by mistake we multiply euros by 0.87 and we keep the units, it becomes euros multiplied by euros. That gives you euro square divided by dollar. As soon as I say euro square, you are going to laugh at me and say something is wrong with him. The units don't work out. So yes, dividing is the correct thing to do. Of course, the question we're asking is how many 87 cents are in 1 million euros? And the answer is 1,149,425.29, and every 87 cents buys a dollar. Okay, now we got dollars in London. 1,149,425.29 dollars. But we didn't really want dollars. This was a dollar-based market, and they made us do our trade in two steps. We really would like to have yen. We like to purchase yen with our euros because yen is cheap in that market. Euros were expensive. We sold them, and now we want to purchase yen with the proceeds because yen is cheap. We want to know how many yen would we get if we give all our dollars to the London market. Well, the quoted rate was 111.91 yen per dollar, and we have 1,149,425.29 dollars. Here we should multiply. Again, you could keep the units, and if you have dollar multiplied by yen divided by dollar, the two dollar signs cancel and the answer comes as yen. 128,632,183.91 yen to be precise. Of course, you could also reason that for every um, dollar you get 111.91 yen. So, how many yens do you get for 1,149,425.29 dollars multiplied by 111.91? Now we go back to Tokyo. So let me summarize. So far, in two steps in London, we sold euros and we purchased yen. All we have now is yen. We take this yen to Tokyo, get in touch with traders in that market, and we ask them to make it into euros because euros are cheap in Tokyo and we are purchasing them. We are selling the expensive yen in Tokyo. We have 128,632,183.91 yen. The cross rate coded to us for yen against euro was 128.03 yen per 1 euro. And we want to know how many euros we get. Well, for every 128.03 yen, we get 1 euro. Let's divide 128,632,183.91 by 128.03. And using our old calculator, something that you would definitely need in my exam, calculators are allowed and you should bring them in. We get 1,004,703.46 euros. Now we get to arbitrage profit. In fact, if you do this exercise in the exam and you get to an arbitrage loss, then simply go back and purchase what you sold. and sell what you purchased. The idea of arbitrage was to buy something cheap and sell it expensive. If you do the reverse, um, if you buy something expensive and sell it cheap, you would have a loss. So if you see a loss at the end, you know that you have done it reverse. It's easy to go and sort of mechanically change it. But here, fortunately, we have a profit. We started with a line of credit of 1 million euros, and we ended up in few seconds with 1,004,703.46 euros. Not too shabby of earning 4,703.46 euros for a few seconds of work. In fact, one wants to keep the time as short as possible. This is called an arbitrage profit, but not so fast. There are things that can go wrong, or there are additional issues that I would like to bring up at this point about arbitrage. Number one, bid and ask prices and how they are different. You may know about bid and ask prices from your other courses, or you might have seen it in financial papers and news. Basically, the idea is that a dealer sells you at one expensive price and purchases from you at that very same instant of time at a different cheap price. Sounds unfair. Let me give you another example. If you go to cashier at an airport and you hand them 100 euros and they count dollars and hand it to you, and then if you take the same dollars and give it back to the dealer or to the cashier and ask for euros, you don't get 100 euros back. Maybe you get 94 euros back. This 6 euros was lost in a round-trip transaction. By round-trip transaction, we mean that you sold your euros, purchased dollars, now you sold your dollars and purchased euros. And all of it at a very short instant of time. Yes, the dealer has two different prices, but this is not unfair because the dealer has an overhead, people who work for her or him, and also keeps an inventory of money that when interest rates are significant, this money has cost of capital. So this bid and ask spread, or the fact that the dealer purchases cheap and sells it more expensive, uh, gives the dealer a fair profit plus cost of doing business. Of course, fair is relative, but you see the justification for this bid and ask price being different. We also have a different problem as students and teachers, and that's remembering which price is the bid price and which price is the ask price. I have a nice trick for doing this. The word buy, B-U-Y, starts with B, and the word bid starts with B. So bid is the price for buying or for purchasing something. When you look at the ask, think of asking price. When you purchase something, um, when you put it up for sale, and so shouldn't say you purchase it, you put it up for sale, you have an asking price. So ask price is the price for selling. The matter gets a bit more complicated because there are two points of views: the point of view of the buyer and the point of view of the dealer. In finance and economics, we always talk about the point of view of the dealer. So bid is the buying price when the dealer buys from you. Ask is the asking price where um, the dealer sells to you. So they are both from the point of view of the dealer, buying and selling price. If we look at your point of view, um, when the dealer buys from you, you sell to the dealer and the price becomes opposite. This point of view becomes opposite. So bid the buying price from the point of view of the dealer who buys something from you, and um, asking price from the point of view of dealer who sells you something. It also becomes important to talk about the currency here. Is bid price the price for buying dollars when dealer buys dollars for you, or is bid price the price for buying euros when the dealer buys euros from you? Convention in these dollars is that dollar convention in these markets is that dollar is usually the base. So bid is the bidding price for buying dollars from the point of view of dealer, and ask is the asking price for selling dollars from the point of view of the buyer. If we are in a cross market and dollar is not involved, then we have to mention which currency um, is the one that we are focusing on. Okay, but this bid and ask price cost us something. Let's go back in my slides. Here is our first slide. I gave you two quotations. $1 equals 111.91 yen. But I didn't tell you if this was bid price or ask price, the price for buying dollars or for selling dollars. If I want to give you bid and ask price, I have to give you two prices. Same thing for a dollar versus euro. We need two prices there. And same thing for this Tokyo spot market price. We need a bid and an ask price. Should we go back and redo this whole Harvard Business School with a pair of bid and ask prices? That would make all these calculations that we have here more complicated. And perhaps it would be harder for us to learn it. Well, sometimes easier is better, but we have a better reason for not doing this. The dealers in foreign currency markets also don't uh, deal with the bid and ask prices. They calculate with one price, but they know that they are going to lose some money to the fact that there is a bid and ask spread, or in other words, the dealer takes a cut. And with experience, in a slang, in English, we say by the seat of their pants, They know that certain difference between the two prices in for the same item in two different markets does not justify doing arbitrage. You can make money off it because the difference is not enough to pay for bid and ask price differences. When the prices are more than that many points apart, they can do arbitrage. Those many points are something that in the classroom we don't precisely know. It depends on trade in one currency, and those traders, those arbitrageurs do it all the time, so they have an idea of how much difference in the two prices allows them to actually make a profit. Next, we go to execution risk. You and I talked about execution risk before. This is the risk that the market price changes. Arbitrager tries to buy it cheap and it suddenly becomes expensive when the order is actually executed. And when you sell it, the expensive price becomes cheaper because other arbitrageurs have sold before and there is too much selling going on, and therefore you might lose money. This execution risk causes a loss once in a while in arbitrage trades. The way that the dealers deal with this is very similar with the bid and ask price. They look for a profit that is large enough to pay for once in many trades, for example, 1 out of 100 trade, that they would lose money to execution risk. The other trades should have more of a profit to make up for that risk. And this price difference is something that the dealer knows by practice. All right, so this bid and ask price cause a cost that arbitrager has to pay. We could think of this as a cost of doing business. And execution risk is also a cost of doing business. I explained that traders look at a price difference that justifies doing business. We call this a rule of thumb, a slang for saying, based on experience, you know the price differences between something being cheap and expensive that allow you um, to make a profit after you pay for bid and ask and execution risk and other transaction costs. Transaction costs means cost of doing business. For example, having an employee uh, that may arise in this situation. That gets us to the end of our lecture and our classwork together on triangular arbitrage. Up to this point, you have a script or lecture note on triangular arbitrage, and you have this triangular arbitrage recorded lecture. Um, After viewing both of them, please do a classroom exercise and hand the classroom exercise via email live today during the lecture period. And of course, if you have difficulty doing this exercise, you can ask me questions via email. Once I receive an email from all class members, um, I would move to our next lecture, and of course, I answer all the questions that you may have. And this way, we are all confident that this lecture is completely covered. Then we move to the next lecture. Here is the classroom exercise. The dollar-based spot market codes in London are a dollar equals 107.91 yen and a dollar equals 0.87 euro. You want to calculate the implied rate, and you want to compare this with Tokyo spot market, which has a coded rate of 1 euro equals 128.03 yen. Once you do that comparison, you want to figure out where euro is cheap and where it's expensive, in which market. And then you want to do a full arbitrage and get to a profit and report all the steps that you have taken, exactly like the exercise I have done, and show your profit. Here is our second classroom exercise. In the first exercise, all your answers should be the same because there is one right answer. In this classroom exercise, all your answers should be different because you are working individually with different numbers. It says look up the exchange rates for different currencies that you like. Not necessarily dollar versus yen, but two other major currencies of the world of your liking. Also, search internet for implied rates um, which are calculated based on these dollar-based values. I shouldn't say search internet, I should say calculate this implied rate based on these $2 based codes that you get from internet. For example, you could do British pound versus dollar and euro versus dollar. Also find a cross rate, a direct rate between the two currencies that don't involve dollar. Here again, compare these two rates. If the two rates end up being the same, you're allowed to play with your rates a little bit different from reality. So the um, cost rate and implied rates are not the same. Then work on arbitrage. Write the details exactly how I wrote them in this lecture notes and email me your work. So change the rates slightly so that your work is different from your other classmates and also your work allows for arbitrage. I would like to receive both of these exercises today and receive questions about them today during lecture hours. Of course, these lectures are flexible. You could leave for 15 minutes, 20 minutes, do something else. But you want to review these lecture notes, do this exercise, and hand them in. Once I have them, I have all 13 of you reporting your two exercises. I would send you the next lecture. It was a pleasure doing this lecture together, and I'm looking forward to your answers.